To start a business, you need some capital, you put in hard work, you take some risks, and for that, you expect some returns. Every business has all of these components, although the extent might be different. If you're a freelancer, you put in a lot of work, but you need very little capital and you don't take much risk. If you invest in ETFs, you need a lot of capital, you take a significant amount of risk, but the work is very limited. If you start a short-term rental business, you also have all three components. This type of business typically comes in 3 phases. In the first, you build the property and the business. In the second, you operate the business on an ongoing basis. And in the third, you exit from that business. These phases are very different, but each phase generates value. The build phase typically starts with a high-level market analysis. You try to find out if the market is attractive at all. One aspect to judge the attractiveness of a market is the ratio of rent to price of a property in the context of the interest rates. To evaluate this, you pick a couple of random properties and compare the annual rental revenue with the purchasing price of a very similar unit. In this example, I take the 5,800 monthly rent of an apartment in Singapore, annualize it, compare it with the purchasing price of a very similar unit in the same building. The result is a rental yield of about 4.2%. I look at the mortgage rates in the same area to have a benchmark for the cost of capital. In this case, it is very obvious that the rental yield will not cover the cost of capital, so the investment will not be cash flow positive. An investment in a condo in this market will be based on the hope to sell it at a later point of time at a higher price. You might end your analysis at this point already, or if the result is more promising, continue with additional verification of your results. Another interesting indicator would be the occupancy rate of similar objects in that area. Doing the same calculation for a 1-bedroom townhouse in Canggu, Bali, with a daily rate of $236 and an occupancy rate of 70%, results in an annual revenue of $60,000. With a purchasing price of around $200,000, the rental yield is about 30%, therefore significantly higher than the cost of capital. Now that we found an attractive market, it is time to break it down in different segments and identify in which segment we want to be in. For that, identify dimensions that seem relevant in your market. In this example, I picked the size of the properties as well as the standard from luxurious to very basic to analyze further. I look at different platforms like AirBNB to identify future competitors. I select properties that seem to be working as a business, for example having a higher occupancy rate than 70%. I estimate the average daily rate based on advertised rates for high season, low season, and general season. Then I place the different properties in my metrics and note down the average daily rate. With this, I can identify which of the segments seem to be working and where there is competition with a working business model. But I can also get more insights into the profitability of different segments. To be more precise, I can also isolate each dimension and add price as the other dimension. In this case, I can already see that a very large villa generates about twice the revenue of a very small villa with a comparable standard. Given that a very large villa costs about 3 times as much as a very small one, it seems that a small villa has a higher profitability. I can also see that a luxury villa has a much higher revenue than a basic one, where obviously the cost is higher, but not to the extent as the revenue increases. So it seems from this chart that the segment of small luxury villas is the most profitable. With all this analysis done, you can draft your proposed property. The location, the size, what style of architecture, the estimated construction cost, high-level operating model, consider outsourcing of operational activities, and the expected revenue range. What is a reasonable expectation in terms of occupancy rate as well as average daily rates? All this analysis is incomplete without assessing the risks related to the project. I made an entire video that helps to identify some main risks related to property investments. Identify the 3 to 5 risks that you are most concerned about with regards to your project. In this example, I use the bankruptcy of my developer as one risk and an earthquake destroying my property as another major risk. For each risk, you need to estimate the likelihood and the impact of it onto your project. For the bankruptcy of my developer, I assess the likelihood as medium and the impact as medium. While an earthquake destroying my whole property would have a very high impact, but depending on the region, it is most likely very low. And only in few regions it should be considered at all. Plot your risks in a matrix with likelihood and impact. And only when impact and likelihood is at least medium, you should consider these risks for further treatment. Typical options for risk treatment are insurance. So in case of fire, earthquake, flooding, you can get an insurance for that. Do keep in mind that the insurance will typically cover the cost of repairs to your property, but not the lost revenue during the time. Therefore, the transfer of the risk is only partial, and a part of the risk will remain with you, and you need to accept this. Another option you have is to mitigate these risks. So for example, the risk of the developer going bankrupt can be reduced by setting up a decent payment schedule, so you only pay as the progress of the construction goes. This exercise gives you a good overview on the residual risk that you cannot transfer or mitigate. So this is a risk you need to accept when you start your project. Add a summary of the residual risks to your business case in order to make a solid decision on whether you should pursue this project or not. Consolidate your business case with a description of your property and business, the budget, the financial forecast, and the risks associated with the project. List any assumptions you made along the way and evaluate if you can verify these assumptions. By now you have all the information to make a decision whether you go ahead with this project or not. If you decide to go ahead, it is time to buy the land and build your property. While your property is under construction, it is time to define the operating model. While you already have an idea on your strategy, you're in the hospitality business, so everything is about the guest experience. At the heart of that is obviously the stay at your property. But keep in mind, the guest experience does not start with check-in and does not end with check-out. Between your strategy and the guest experience is your operating model, managing all the day-to-day activities. From guest communications, answering the questions they have before or after they book, managing the bookings, to purchasing of supplies. And of course, a lot of cleaning before the stay, after the stay, during the stay, and also after checkout. Obviously, you need to manage the reviews, but you can do more than that. You can communicate with the guests after they left, inform them about new amenities you have installed, and remind them how nice your property is so they come back. And of course, you need to manage the maintenance of the property and also accounting and tax. On a more strategic level, you have to define a pricing strategy. Marketing, which channels are you using? Keep an eye on your competition and how the market is moving. Also, you need to manage your suppliers, audit what's going on, and make sure you have the tools and processes in place to work efficiently. And one of the most important aspects of this is quality assurance. Your day-to-day activities might be outsourced, at least to some degree. Quality assurance, especially of the outsourced activities, is extremely important to maintain a high level of quality. Once your business is up and running, it is important to optimize your business like a fine-tuned machine on an ongoing basis. For that, you need to understand your business and your market in all detail. Identify the KPIs, the key performance indicators that are critical for your business success, and understand how they relate to each other. For example, occupancy rate and average daily rate are some of the key indicators to make short-term rental work. These indicators are not independent of each other. Obviously, you want the occupancy rate to be high, but the easiest way to have a high occupancy rate is to have a low price, and you end up with little revenue. Of course, you want the daily rate to be high, but that brings the risk of a low occupancy rate. So what you actually want to optimize is more the revenue than occupancy rate or average daily rate. To optimize for revenue, you need to manage the prices in a way that the occupancy rate is high enough to generate the highest revenue. But actually, you don't want to optimize for revenue. Your fixed cost will push your revenue curve straight down. However, the variable cost increase with a higher occupancy rate. So with that, it shifts your profit to the higher average daily rate and potentially lower occupancy rate. Understanding the dependencies between your KPIs is key to optimize your business. And all these factors need to be fine-tuned on an ongoing basis throughout various seasons and changing markets. When you want to sell your Airbnb, you fundamentally have two different options. You can sell it as a business, or you can wind down the business and sell it as a property. A well-performing business should be valued at a premium over the assets it includes, in this case, the property. However, keep in mind that it's a very different market of buyers for a business and of buyers for a property. So you might not be able to realize the higher valuation of your business. So if you want to sell, the choice of selling a business or selling the property might not be yours, but based on the demand of the market. Either way, over the lifespan of your investment, if the Airbnb has been operating profitable over many years, it should have been a profitable investment overall as well.